Good afternoon and welcome to the Transportation Federal Credit Union 2024 Lunch and Learn series. Today's presentation is brought to you in partnership with GreenPath, a nationwide financial counseling and education organization focusing on improving the financial health of individuals. As the premier credit union of the transportation community, we have joined with GreenPath to expand our mission of providing quality financial education to our community and lending insight into credit management, home ownership, and money management. Transportation Federal Credit Union is a full-service financial institution serving employees and contractors of the Department of Transportation, the Federal Aviation Administration, and over 100 plus employer groups in the area. We currently serve over 15,000 members in the area and welcome you to come and experience the benefits of membership as well. Later on in the presentation, we will display some contact information and answer any specific questions you may have concerning your financial needs. Please note that today's webinar is live and all phone lines have been muted. If you have questions, please feel free to type your questions or any concerns into the question field on the right-hand side of your menu bar. All questions are private and will be addressed at the end of our discussion. We will also be offering a free 45-minute financial coaching session with the completion of 3 webinars. For more information will be given at the end of today's presentation. Lastly, a recording of today's session will be available within the next business day for your review. Details will be sent to your email following the presentation. And with that, we will turn it over to our presenter for today, Bill Fowkes from GreenPath. Hello, Bill. How are you?
I am good, and thank you for the introduction, and thank you everyone for joining us for our webinar today. And our webinar today is titled Keys to Home Buying. And what we're going to be doing today is we're going to be walking through the steps home buyers take from preparing to purchase a home to working with a realtor and lender. And it's also going to include searching for a home, making an offer. We'll also cover what happens after your offer is accepted and on closing day. And before we end, we're going to wrap up with some keys to successful home ownership long term. And so I want to start by preparing for the purchase. And making a decision to purchase a home is exciting, but it's also potentially overwhelming. Houses are typically going to be the largest purchase that most people are going to make. So you want to make sure that you're prepared as you enter the process. So the first thing you want to do is you want to work on gathering the documents you're going to need when working with a mortgage lender. Exact documentation that's needed may vary, but typically it's going to include 1 to 2 years of W-2s and tax returns, at least 30 most recent days of consecutive pay stubs or sufficient proof of income, and at least 2 most consecutive recent months of bank statements, as well as statements for any investments or other assets you have. If a relative is gifting you funds toward the purchase costs, they will need to write a letter guaranteeing that this is a gift and not a loan from the individual to the buyer. You may also be asked to share proof of your rental payment history, especially if you're applying for an FHA loan. Now, once you've gathered all these documents, you want to use them to determine and create your budget. Start by reviewing your income and determine your net income, which is the amount of money you actually take home after taxes and deductions are subtracted. Next, list all of your expenses. Use your statements to review spending and determine actual amounts for each expense category you have. It's helpful to look across multiple months to find an average of expenses, as those expenses can vary from month to month. Your goal is to have a solid understanding of where each dollar you earn goes so that you know how much money you can afford to spend comfortably on a mortgage payment. Once you've developed this list of expenses and developed a budget of how much you estimate and would like to spend on each expense category, spend a month or 2 tracking your spending carefully to ensure you have captured all of these expenses accurately and confirm that you're comfortable with the budget you've developed. This will be a key step in determining how much money you can truly afford as you start looking at homes. It's also recommended that you review your credit report as soon as you start to think about purchasing a home. And you can review your credit report from all three credit bureaus, TransUnion, Experian, and Equifax, for free at annualcreditreport.com. Reviewing all three reports is important because some creditors may not report to all three bureaus, so information can vary. Reviewing all three reports can help you have a clear picture of everything reporting under your name. And if you find any errors or any inaccurate information, file a dispute with the credit bureau directly. This process can take a bit of time, so the sooner you can start the dispute process, the better, to help avoid holding up the mortgage application process. If you have negative items on your credit report that are legitimate, those will not typically be able to be successfully disputed. However, you can add a notation to your credit report explaining the negative items, especially if there's an emergency or situation out of your control that led to accounts falling past due. This notation will not impact your credit score or remove the negative item, but it can give some context to the mortgage lender reviewing your credit and allow them to take that into consideration. Once you've laid the groundwork and ready to start taking some concrete steps towards finding and buying a home, you will want to find a realtor and a lender to work with. These individuals will be guiding you through this large purchase, so you're going to want to make sure that you trust them and feel comfortable working closely with them. Now, Transportation Federal Credit Union offers the Home Advantage programs to its members, and Home Advantage is a program designed to connect top local realty professionals and home buyers and sellers together. So if you have more information about that, you can contact Transportation FCU directly. Now, when looking for a realtor, it's a great idea to start asking friends and family in your area who they have had good experiences with. Just as important, be sure to find out if there's anyone you know who's had a negative experience with a realtor. You can also search online for recommendations of local realtors in your area. Be sure to read reviews carefully and do thorough research before making a choice. Consider interviewing a few realtors to decide who is the best fit, especially without personal recommendations from family or friends. As you research and interview potential realtors, it's important to make sure they have proper credentials. Of course, reputation is important, and you will want to make sure that they have the proper expertise to guide you through the process confidently. What experience do they have with the real estate market are you planning to purchase in? You want to make sure they do have experience in that market that you're looking to buy in. And if you're looking for an agent, consider using Home Advantage. Home Advantage is a free service that the credit union offers, that Transportation Federal Credit Union offers, which allows you to connect with top-notch agents and to find your dream home and have access to customized home searches. In addition to finding a realtor to guide you through the process, you also want to find a lender to help you finance the purchase. Start your search by meeting with the mortgage department at your credit union, and this lender as a lender you've already have a relationship and trust, so it's a great place to start. If you want to search around and compare rates across a few lenders, you want to get all your ducks in a row and submit your applications within a short period of time to limit the credit impact. If applications are spread out over several months, you may start to see your credit score drop due to multiple hard inquiries over a longer period of time. If the inquiries are closer together, ideally 1 to 2 weeks, it'll be obvious that you are rate shopping and will not have the same negative impact on your credit score. So before starting to search for your home process, start by looking at specific homes and apply for pre-approval. This will help you know for sure how much financing you'll be able to get so that you know what price range to search within. It's imperative to get pre-approved before looking for a home to prevent the deep disappointment of falling in love with a home that is outside of your price range, and you want to make sure you'll be able to get a mortgage for the home that you want. It can be exciting to start looking for specific homes, but don't skip the step of getting pre-approved. A pre-approval means that a lender is tentatively willing to finance a mortgage up to a certain amount. This is not a guarantee that they're going to give you the money, but it let buyers know that you've started the process and have reason to believe that you should be able to obtain sufficient financing when you make an offer. This can also be a leg up if you place an offer on a home that has multiple offers. A pre-approval gives the seller confidence that you're going to be able to move forward to close. Final approval will come after you found a specific home and move forward with requesting a mortgage for it. When issuing pre-approval, it's imperative that you know you can comfortably afford it in your budget first. A lender typically won't look at all of your living expenses, so they may pre-approve you for a loan that is far more than you can comfortably afford on your monthly budget. Know what you're comfortable spending overall on a home, as well as what you're comfortable spending on a monthly mortgage payment, and share this with your lender upfront, because just because you're pre-approved for a certain amount doesn't mean that you can afford to pay it. You're also going to need to be pre-approved with sufficient savings for down payment, closing costs, and other upfront expenses. Now, how much these things can vary depending on how much you're purchasing a home for, and sometimes even who the investor is. But this is going to be important to consider when determining for sure what price range you can afford to search for homes in. And finally, it's important to know that your property taxes and homeowners insurance, which are typically included in your mortgage payment, are likely to change over time. When figuring out what monthly amount is going to be that you're comfortable with, you want to make sure there's wiggle room for the payment to increase without causing strain. And this can happen as soon as the first year after buying a home. In many states, that is the case. Before I came to work at GreenPath, I worked in a treasurer's office and I dealt with property taxes. And I had a lot of conversations with people who were not expecting their property taxes to change as significantly as they did in the first year. And that's not just a Michigan thing where I'm at. That's something that can happen wherever you are. So you want to make sure that you're speaking with your realtor and the lender, and maybe even your local tax assessor, and making sure that you know what those taxes are going to be once you buy the home. Now, once you've chosen a realtor to work with and identified the price range you're comfortable with and received a pre-approval from at least one lender, now it's time for the fun part, searching for your home. It's unlikely you'll find the perfect dream home that checks every box on your wish list. So it's important to think about what are non-negotiables and what are nice to have features, but also things that you're not willing to budge on. Choosing location is one of the first decisions you're going to need to make as you start your search. Those questions include things like, what neighborhood would you like to purchase in? Do you plan to have a family? What school district would you like to live in? How close you want to be to the school for your kids to attend? How far away from work are you willing to live? Are there public transportation options that can get you to work easily? And is that important to you? What are property taxes like on average? Taxes can vary significantly in some areas, and if the property taxes increase, as we talked about a few moments ago, or they're higher than expected to begin with, it could break the budget, as it may lead to a mortgage payment that's out of the range you're comfortable spending, even if the purchase price is right. It's also helpful to think about what other places you frequent and determine how close or how far away from them you would like to live. Consider what other things you like to live near, such as parks, libraries, grocery stores, public transportation, your church, or anything else that's important to you. And finally, when choosing a location for your new home, it can be helpful to look into things like noise and traffic levels, as well as safety considerations. Beyond location, you also want to identify what needs and what your wants are. Start by considering things like the number of bedrooms and bathrooms. What's an ideal number, and what is a non-negotiable number to meet your needs? You may also want to think about square footage needs, as well as what style of house you're interested in purchasing. Single family home, a duplex, a townhome, or a condo. Do you want a one-story home or two-story home? You may also want to consider the aesthetic and floor plans that you like as well. Do you love to be outdoors? Do you dream of planting a huge garden, or do you want to leave room for your kids and pets to play and run around freely? Outdoor space is another thing to consider. So, and you want to also consider what's a need and what's a want. The kitchen is also a key thing that many people may have needs and wants related to. Take time to determine what you need and what you want, and what you may be willing to compromise on, but what what you could potentially modify later. What other features of the homes are needs for you or your family? Identify these non-negotiables and share them with your realtor so that they can help you search for those homes. Once you find a home that meets your needs, and hopefully many of your wants, it's time to make an offer. When determining what to offer the seller, you will want to consider what purchase price you would like to have the seller agree to. You can also include any contingencies you may want to include, which can range from agreeing that the buyer can bow out without any consequences if the appraisal comes in too low, or the inspection indicates drastic repairs to agreeing to drastic repairs to agreeing that the buyer has time to sell their current home before closing on a new one. When I bought my home, that's one of the things that the seller insisted on. They needed to find a new home. And so it was about almost 90 days before my wife and I were able to move into our home after we bought our home. The buyer may also want to request certain concessions from the seller in their offer, such as the seller assists that will cover some of the buyer's closing costs and reduce the amount of cash a buyer would need to close. There are limits to the percentage of costs a seller is allowed to cover, so be sure to talk this in detail through your realtor. You can also include when you would like to close on the home and move into the property. You can also provide the buyer with a deadline to respond to your offer, as well as indicate how much money you are willing to put down as earnest deposit money. This indicates to the seller that you are a serious buyer and plan to move forward with the purchase. Giving them reason to confidently remove their home from the market is going to go a long way toward making them comfortable with you, and that's why you want to make sure that you're discussing that earnest money deposit. And any earnest money deposit you put down goes toward your closing costs or down payment at the time of purchase, reducing the amount of cash you need to close. Now, once you've submitted an offer on a home that you're excited about, hopefully it will be accepted by the seller. There may be some negotiation which you will work on with your realtor, but once the offer is accepted, there are some important steps you need to take to close the deal. So the first step to actually fully apply for the mortgage with the lender of your choice that pre-approved you. There are a variety of mortgage types available, and your lender can help you determine which might be right for you. The most common mortgage type is what's known as conventional mortgage. These tend to have stricter lending requirements and are typically an option that makes the most sense for someone with a high credit score. An FHA mortgage is designed to make homeownership possible for more people, including those with slightly higher credit costs credit scores or lower incomes. These mortgages are backed by the Federal Housing Agency, and with a lower down payment and credit score requirements, FHA loans can be a great option for many first-time home buyers. If you are a veteran or active duty service member, the Veterans Administration mortgage may be a great option for you. National Guard Reserve members may also be eligible for VA loans that allow you to purchase home with little or no money down, competitive interest rates, and oftentimes limited closing costs. Veterans or service members must obtain a certificate of eligibility through the VA, and your lender may also be able to help you obtain this. Another government-backed mortgage is called the USDA loan, which is specifically for properties that fall in defined rural areas. Buyers must meet certain income requirements, but are eligible for 100% financing, meaning no money down. The home must be located in a USDA eligible rural area to apply for this mortgage type. When applying for a mortgage, you may also be offered a fixed rate option and an adjustable rate option. A fixed rate mortgage means that the interest rate will remain the same for the life of the loan, while an adjustable rate mortgage may change over time. Typically, adjustable rate mortgages offer one rate for a defined period of time, after which the rate may change to match market rates. This could mean your rate increases or it could decrease. When considering whether a fixed rate or adjustable rate mortgage makes sense for you, it can be helpful to think about how long you plan to stay in the home. Talk this through to your lender, with your lender. If you plan to stay 5 years or less, it may make sense to weigh your options more carefully. One thing that can be helpful to understand is the difference between the APR and the interest rate. The interest rate is the percentage you're required to pay to borrow the money for a period of time. The APR includes the interest rate, but also adds in other fees that you will pay to the lender in order to better represent the total annual cost to borrow the money. Comparing the APRs when choosing a lender can give you a better idea of the more affordable option compared to just looking at interest rates. And while it is possible to get a mortgage with less than 20% down, you would typically be required to pay for additional insurance that protects the lender because they're taking on more of a risk by lending you more of the home's value. If something were to happen and you were to default on the mortgage, the lender is at a higher risk. And this insurance is called PMI or for conventional mortgages, or MIP for FHA mortgages. PMI, which is short for private mortgage insurance, is typically required if you obtain a conventional loan with a down payment lower than 20%. Once you reach 20% equity in your home, you can reach out to the lender and request your PMI be canceled. If you don't proactively request a cancellation, it will automatically be removed once your principal balance reaches 78% of the home's original value. Mortgage insurance premium, also known as MIP, is required for all FHA loans, required of how much money you put, regardless of how much money you put down. A few key differences between MIP compared to PMI is that FHA loans require not just the annual MIP, but also an upfront payment as well. The upfront MIP can be financed as part of your loan, and both MIP and PMI are typically paid as part of your mortgage payment. Another key difference is that the MIP would typically be required for the life of the loan unless your down payment was 10% or more. If you made this size of a down payment, MIP will cancel after 11 years. If your down payment was less than 10%, your MIP will not cancel until the loan is paid off, or if you were able to refinance into a conventional loan after reaching at least 20% equity. Typically, your monthly mortgage payment includes four main components. That's going to be principal and interest, as well as taxes and insurance. And we talked about one form of insurance, but you will also need homeowners insurance for any mortgage, and we'll have property taxes to cover as well. While property taxes and homeowner insurance are typically paid once a year, or depending on where you live, like here in Michigan, it's twice a year. You can pay towards that annual amount on a monthly basis as part of your mortgage payment. This goes into what's called an escrow account, which your mortgage company will hold onto and then use that to pay your taxes and insurance premium when they come due for the year. Once a year, your lender will review the escrow account to determine if sufficient amount is collected to ensure the taxes and insurance can be paid on time. They would send you a notification letting you know if the mortgage payment will increase or decrease to maintain future payments. It's important to know that this can happen as soon as the first year after you repair your home. So be prepared, after you purchase your home. So be prepared for this possibility. When determining whether or not they can extend a loan to you, the underwriter may look at a variety of different factors. The first of which is capacity, and that means, do you have the ability to repay this loan if it's extended to you? Underwriters will review your income and employment history, how much money you have in savings, your current monthly debt payments, and other financial obligations. They will review how the requested mortgage fits into this and ensure you're likely capable of financially managing all of your obligations. That's how they decide capacity. The second thing they're going to look at is capital. Do you have cash or assets available that you could turn to if needed to meet your obligations to repay this loan? This also shows a potential lender that you have excess funds available on a monthly basis to save or invest, further proving that you can afford to take on a mortgage payment. The next thing underwriters will consider is your credit history and score. This will indicate to the lender how you've managed accounts previously, as well as how they are currently managing the credit accounts, to indicate how risky it is for them to extend more credit to you. The higher your credit score, typically the more options you have available to you and the better rates you will have. While it's possible to obtain a mortgage with a lower credit score, it is in your best interest to get a credit score as high as you can before applying for a mortgage. And finally, underwriters are interested in the collateral you are pledging to this loan. For most mortgages, this will be the home itself. The underwriter will want to ensure the home is worth enough to cover their losses if you were to fall behind on your mortgage so far that they needed to foreclose. This is typically determined through a home appraisal. Once you've submitted a full mortgage application, you receive a loan estimate. And the lender is required to provide you this within 3 business days after receiving your completed application. This loan estimate is not a guarantee that your loan application is approved or denied, but it's designed to give you all the details that you need to know if you decide to proceed with seeking this loan. And that's going to include the interest rate, the monthly payment you're expected to pay, including estimates for the portion that will go to taxes and insurance, and the estimated amount of closing costs and estimated total amount of cash you will need in order to close, which is typically going to need to be paid by wire transfer or cashier's check on closing day. The loan estimate will also provide you with any other unique details or expectations related to the loan. This is a document you will want to review thoroughly and make sure you fully understand before agreeing to move forward. After the loan application is submitted, the next step is the home inspection. Home inspections are typically not required, but they're highly recommended. A home inspection is for your protection as the buyer, is to help you enter the purchase with a clear idea of flaws or warning signs on the home. You, as the buyer, will choose a home inspector, so be sure to shop around for one you can trust. FHA loans may require a specific inspection to ensure the property meets certain standards. It is still recommended you hire your own inspector to look through a home, to look through the property thoroughly as well. When you've made your offer, you may have included contingencies related to the home inspection findings. If the inspection shows a major issue with the system or a large repair is needed, you may be able to negotiate with the seller to ask them to fix it to reduce the purchase price if you prefer to fix it yourself, or you may have a right to cancel the agreement and to purchase home altogether if you're dissatisfied with the inspection or cannot agree with the seller on resolving concerns. This is something to talk to with your realtor about in detail when submitting an offer to make sure you're fully covered as a buyer if the inspection reveals major concerns. A home appraisal is different from a home inspection in that an inspection is designed to give the buyer a clear picture of the condition of the home that it is in, while the appraisal is designed to let the lender know how much the property is worth. The mortgage lender will hire an appraiser and work with you to schedule it. Unlike a home inspection, you are the buyer and you choose the appraisal. The lender chooses the appraiser. So let me clear that up because I don't know if I said that clearly. You choose the inspector, the lender chooses the appraiser. Typically, you don't have any say over who's going to actually do that appraisal. The appraisal will confirm how much money the mortgage lender can extend to a loan for you based on the value of your property. If the appraisal comes in lower than the amount you're asking to borrow, you will either need to come up with more money to bridge the gap or potentially see if the seller is willing to negotiate. Once you've gotten through all the paperwork, phone calls, inspection, appraisal, and gathered all the money you need, it's time for what many consider to be the exciting part, and that is closing day. Now, leading up to closing day, you're going to receive some documents ahead of time to review that can help to speed the process up a bit at the closing table. You will want to review these documents closely and reach out to your realtor or lender immediately if something seems incorrect or weird to you. Legally, you're required to be sent your closing documents 3 business days before you're scheduled to close. You will also want to confirm with the realtor the exact location to meet for closing and plan to arrive early. You can also request a final walkthrough of the home, which can be used to confirm the seller has made any requested repairs and make sure the home is still in as good, if not better condition as it was before, and verify that all agreed upon appliances remain in the home. Prior to closing day and receiving your keys, you will need to reach out to the utility companies to schedule all utilities to transfer to your name by the day you plan to take possession of the home. Even if your move-in date will be delayed, you will still want to move utilities over as the day of the property is officially yours. You will also want to connect with your realtor and lender about what you need to be sure to bring with you to the closing table. This typically is going to include a valid photo ID for all borrowers and a certified or cashier's check if you're not using a wire transfer for your closing costs and down payments. And after you've signed more paperwork than you can imagine, handed over a large sum of money and gotten your keys, then congratulations are in order because you are officially a homeowner. The journey doesn't stop with walking through the front door for the first time. And so before we wrap up our time together, we want to make sure to share some successful homeownership keys beyond closing day. The first tip is to prioritize rebuilding your credit as soon as possible. If most of your savings went to down payment, closing costs, and moving expenses, it can be tempting to jump into renovation projects and improvements, but pausing first to get money tucked away for emergencies is recommended. As a homeowner, when an appliance breaks, you're responsible to fix it or replace it versus being able to call a landlord. You can also open a special purchase account with Transportation FCU to help keep track of your funds for home emergency repairs. It is also recommended that you map out an annual home maintenance plan. This is something you can research online for recommendations of what to include, when to do it, and how often to do it. Figure out a method to stay organized and keep track of the maintenance completed, as well as what maintenance is due. Again, as a homeowner, there are many possibilities for emergency expenses that aren't going to exist as a renter. It's recommended that you keep an emergency fund separate from other savings for things such as home renovations or vacations. This ensures that you have money tucked away for unexpected major expenses that won't be touched until needed. And as we discussed earlier, your mortgage payment may increase as your homeowner's insurance and taxes change. And as you revisit your budget from time to time, keep this in mind to be prepared for potential increases in monthly payments. A lot of times, first-time home buyers, they get confused by that and they say, hey, I have a fixed rate mortgage, my payment shouldn't be changing. And a lot of times they forget about the fact that the taxes and insurance are likely to change. And as you plan what repairs or improvements you want to make to your new home, prioritize any major concerns the inspector has found. These may not always be the most fun or cosmetically pleasing improvements, but they can be the most important to take care of first. You may also want to build up savings to take care of larger repairs, so having a plan for this can be helpful as well. And the final key to successful homeownership is to always prioritize your mortgage. A foreclosure process can begin as soon as 3 months after falling past due on your mortgage. So making this payment your top priority every month is strongly recommended. If you're ever concerned about making your mortgage payment, reach out to the mortgage company as soon as possible to discuss your options. There may be both long and short-term hardship options available, and the sooner you explore them, the better. You can also reach out to HUD-approved housing counselors to talk with someone about your housing situation. Our partners, those of us here at GreenPath, we have housing counselors on staff to help you understand your options. I was a housing counselor for a number of years before I moved into this role, and part of our job was helping you to come up with a plan and even help you reach out to the mortgage company to take action. I had a lot of phone calls like that when I was a counselor, and our counselors still do those phone calls where they're willing to reach out to the mortgage company with you if you need help. And one thing to keep in mind is that housing counseling is always going to be free, no matter who you talk with, or there's GreenPath or anyone else. So don't be afraid to reach out and speak with a housing counselor. And finally, as a member of Transportation Federal Credit Union, you have access to GreenPath Financial Wellness. GreenPath is one of the largest, most trusted counseling agencies in the nation. We work to empower you to eliminate stress, get out of debt, increase savings, and achieve your goals. And if you want advice, you can speak with a financial counselor or learn more on Transportation's website.
Awesome. Thank you so much, Bill. Some
Thank
great
you.
information that you provided for us today. Now we are going to take the time to check for some questions in our chat. So if you have any questions, please feel free to put them in the chat box. We do have one question that we received during the presentation. Bill, excuse me, how do you make sure you pay property tax annually instead of monthly?
Well, in most cases, you're going to pay those property taxes either annually or biannually. In some states, like here in Michigan, your taxes, you get a tax bill in July and December, and it's due in September and February. I always suggest that, and this is before I even came to work at GreenPath, because I worked in the treasurer's office before then. I always suggested that you know when your tax bill is going to come due, and when the tax bill comes out. Because I saw from experience working in the treasurer's office, if the mortgage company forgets to make your payment or some type of mistake happens, which is rare, but it happens, the city isn't going to come after the mortgage company. They're going to come after you. So you need to make sure you know when those taxes are due, how often you're going to get a bill, and make sure that the mortgage company is receiving that bill when it comes out. I don't know if that answers your question or not. But typically when your taxes are going to be due, it's going to be up to the taxing authority where you live.
Thank you. We have another question. Can you lose good faith deposits?
I have heard of situations where people have lost good faith deposits. I mean, and in most cases, it's going to be in the up to that seller. Some sellers are sticklers about it, and their goal of the good faith deposit is that if you have started a home buying process, They want to make sure that you are serious, and that was that. So that good faith deposit is. It really depends on the agreement that was made in that good faith deposit. Now I've heard of situations where sellers might say, okay, I'm not going to hold you to this. I don't want to make things difficult for you. If you have a reason you want to back out, go ahead and back out. But to answer your question, yes, you can lose a good faith deposit. Once you put that deposit down, it's really meant to ensure that you follow through. And typically it's going to go toward the balance if you go toward the purchase price if you purchase it. Like I said, it's really up to the seller. But yes, you can lose it.
Another question, can you provide any information on paying cash for a home?
Yeah, I mean, if you have, and very few people are able to pay cash for a home. But if you are able to pay cash for a home, typically you're going to want to get a lawyer involved to make sure that you're not being taken advantage of, and that you're not missing any steps. A lot of times people might either do that with a cashier check. I've also seen where people who either didn't want to go through a typical mortgage or just couldn't for whatever reason, they might buy their home on what's called a land contract. And that's where there is a contract between you and the seller. And basically, you are paying the seller directly each month through land contract. Typically, that's something that's going to be set up by a lawyer, although you don't necessarily have to have a lawyer to do that. But that's one way people have purchased homes in cash without having finance.
And then our last question, how do I remove escrow property tax from my mortgage and take care of it myself?
That is going to really depend on the lender. I know certain lenders have a requirement that you have at least 20% equity in order to take that escrow account off of the mortgage. Some lenders won't let you do it at all. So it really depends on the lender. I would reach out to them and let them know that you want to remove the escrow account and pay the property taxes yourself. I have seen anecdotal situations. My old boss at my last job, he decided he wanted to do that, and the lender said, okay, but we're going to charge a $200 fee for that. He wasn't happy to do that, but he wanted to pay it for him, pay it himself. So you reach out to the lender and find out if that's something they're willing to do. Some lenders just won't do it at all. As long as you have a mortgage on the property, they're going to want to pay those property taxes and insurance for you. And stuff like that might vary from state to state. There may be state laws that impact that. But you want to start by contacting the lender and asking them to have the escrow account removed and let them know you want to pay the taxes yourself and insurance.
Thank you. Thank you, Bill. Thank you for answering all those questions. And then thank you for helping us with today's webinar today. Thank you all for attending today's educational webinar. To learn more about Transportation Federal Credit Union or to speak to a member service representative, please visit our website at www.transfcu.org or call 800-368-8432. Again, I want to thank Bill, our presenter, and GreenPath for their support today. If you'd like to schedule your free 45-minute financial coaching session, please call GreenPath at 877-337-3399. Thank you all for attending today. Have a wonderful weekend.
Thank you, everyone. Have a great day.